Don Quigley, it's been a very low volume summer for both stocks and bonds. What are your expectations for the fall? Will things pick up?
Yeah, I would expect volatility to pick up for the markets in general, especially August. Traditionally, and especially this month, have been really slow. I think all of Europe went on vacation, and it's been such a policy-driven world. And the Europeans left. Everyone goes, okay, it hasn't blown up. It won't blow up until September. Now we're just waiting. We have Bernanke's Jackson Hole speech on the 31st. And after that, we have consecutively more and more things going to come on that are going to be very influential to the market. So that's when volatility is going to come back.
Great. So we're going to see some action come September. Now, you are over-allocated, let's say, to corporate bonds. Do you sense that there's a bit of overcrowding there? Because it seems that every fund manager I meet really likes corporate bonds.
Well, corporate bonds, the good thing about them is they have a lot more yield than, say, you'd get in Treasuries. So that's why people are going into them, the yield. I don't think it's overcrowded yet compared to spreads, say, in 2007 and 2006. A lot of things are still much wider and much more cheap compared to what they were in terms of spread.
Is there an issue that you like in particular?
Well, one of the ones that we like is Pernod Ricard. And the reason for that is, we were just talking about Europe, they've been thrown out with the bathwater, and it's the baby. And here's a company that has 10% of its revenues coming from France, 30% from Europe, but the rest is international. It's not a European company per se, and yet people are just tagging it as that. And scared of Europe, get out. It's
and if you
for
have
us.
problems, you surely want to drink them away.
Yes, well, exactly. You know, in the last crisis, you didn't see any drop in their sales, let's say.
All right, let's talk about another very large part of your portfolio, and that's in securitized assets. You seem to like commercial mortgage-backed securities better than agencies like Ginnie Mae's and Freddie Mac's. Tell me why.
Well, commercial mortgage-backed securities traditionally have a more predictable cash flow stream. So it's going to act more like a corporate bond in terms of how it pays. And we think these, the ones that we own, are extremely well structured. I would almost call them close to bulletproof. So we don't have to worry about a big event going on and not getting our money back.
A lot of fund managers are getting into agencies. It's a way to get a little extra yield and still get the government guarantee. But let's talk about Treasuries. What's going to happen with Treasuries in the fall?
Well, it's really kind of a hard question. You've got quantitative easing potentially coming up and that kind of thing. But over the longer term, we think that U.S. growth is going to be held down. It's the Reinhart-Rogoff argument, very slow growth after a financial crisis. That's going to keep Treasuries from going down, rising in yield too much, because you won't have any inflationary pressure.
So are investors better off in foreign bonds? In your fund, you seem to like Mexican bonds, you like Canadian bonds. So it seems like you like North American bonds, sovereigns, other than Treasuries.
Yeah, that's a good way to put it. We've got also positions in Brazil and Australia. And it's basically where we either feel there's better risk-adjusted returns, say Mexico or Brazil, or it's flat out just a better economic situation and fiscal situation than you have in the United States, and that's Canada and Australia.
This market has fewer players.
We're coming into a Monday where we're going to
entering a new stage. It's
It's a stock picker's market.
Welcome to the 5 dumbest things
Apple
on Wall Street.
reported earnings.